Looks like a lot of people out there are buying shares or buying stocks. But then again, who exactly is getting rich? Right? By you buying stock, do you automatically get rich? I'm pretty sure you've heard stories of people out there telling you, maybe I bought shares of KCB, of Equity, of Coop Bank, or even beyond Kenya. I bought shares of Nvidia, Apple, you name it. And then they became rich, right? So you too, you could be sitting there wondering, when you buy these shares, do you become rich? Or even yet, you might be a shareholder already. Are you rich from you buying shares? These are the nuances I want us to talk about for us to really understand. First of all, even as you are buying shares and you are selling shares, who is paying you? Is it the Nairobi Securities Exchange? Is it the company which you're buying shares of? Or who exactly is paying you? Because most people out there don't know, but when you are buying shares, it is your fellow investor who's paying you. Nairobi Securities Exchange is a trade platform, okay? It is an exchange platform for securities. Among the securities, there's shares, there's bonds, there's derivatives, REITs, you name it, right? There's a chain of securities. Among them, equities. Under equities, we have stocks or shares. So, when you want to do a transaction, you are basically exchanging, it's a product being exchanged at a given price, right? And that's how it works, because it isn't a company paying you directly, even though the company does influence investors' confidence. It isn't Nairobi Securities Exchange paying you directly. It is you are buying from a fellow investor. Once you know that, then you can move tactfully to figure out how you build wealth, because there are not unlimited shares out there which are waiting for you. Of course, someone has to sell for you to buy. And also, you need to be savvy and technical on how you go about investing and monitoring your investment for you to be able to become rich. In this context, make money at the Nairobi Securities Exchange or whichever stock market out there. And having said that, you are all much welcome to my channel. My name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos about making money and investing each and every day. In case you are new here and you love these videos, subscribe. Down below is a button called subscribe. Click the button, subscribe to join the channel for not to miss any of my videos. And while you still at it, drop a like on this video. Thank you for subscribing and liking this video. As a starting point, you need to understand that you don't become rich when you buy a stock. Think about it like planting a tree, okay? When you buy a stock, you have gotten into the door of being part owner of a company. Now, you being part owner of a company, you got in at a given price, right? You don't automatically become rich or make money when you buy a stock. The point where you're gonna either make money or even unfortunately lose money is when you are selling. And that is gonna be determined by how the stock of that company is gonna be faring on at the point of you selling it. That's one of the ways you can make money. The other way, of course, which I'm also gonna be talking about in this video, is based on company's performance. So if a company is doing well out there, the investor confidence is increasing and increasing, it means the seed which you planted is most likely growing because it is being watered. And that way, you can see the share price increase and increase, right? And that's one of the ways why you can make money in the stock market. And then, the second thing you need to know when it comes to people investing and becoming rich is that companies out here will have already created wealth before even investors jump on their shares. Not all the companies out here are listed at the NSE. It is a class of few companies listed at the NSE, and even when they are listed, businesses out there, management continues to work very hard to grow their profits, okay? They continue to work very hard to manage their expenses and keep generating cash. As companies become more valuable, investors are also taking part in that increase in value. And that is why share prices reflect what investors believe business growth looks like, okay? Better businesses tend to attract more long-term investors because they believe the business is doing well and is going to continue doing well over time. Case in point, when Safaricom began, it was very heavy on calls, okay? And then it got into M-Pesa, then got into data, and continued expanding to business enterprise solutions, you name it. All these additional offers continued improving investors' confidence, and investors believe that growth needs to be reflected in the share prices because it is investors who move the share prices at the Security Exchange. And you understand that, you'll know that you need to also behave like the company. It is a game of long-term investing, right? You don't just invest today and expect the tree you planted to become a mature tree tomorrow. That's not how it works, right? If you want to beat the system that way, you can't beat it in the stock market. And that is why you need to appreciate that the company even created wealth before you got in. So you are getting in to continue working closely with the company. The company continues to create wealth. You as an investor, you also gain. And then the third thing you need to know, which is also something which can shock many people, is that you don't get cash, okay? And know if your cash has increased or not, or if you're rich or not, until you sell your shares. Yes, guys. And this, I'm talking just of it from the lens of the exact things happening at the stock market only, not anchored on the business performance per se. So, all that figures you are seeing, it is paper money, right? Until you sell the shares which you hold is when you're going to get your hand on cash. And that is why sometimes you could find even someone, they have a ton of investment at the NSE, but they don't have cash. They're broke. But in reality, on paper money, they are rich. Reason being, you don't become rich or even get the cash until you sell. Once you dispose the share you are holding, you choose whichever number of shares, if all of them, if part of them, you name it, that is when a fellow investor or a group of investors are going to be paying in exchange, willing buyer, willing seller, because the company doesn't pay you when you are disposing your shares. NSE doesn't pay you. Basically, that money comes from another investor. That is when you can be able to make money, okay? And even be able to cash out whichever your gain is, because everything before that, it is money on paper. I know by now you might be wondering, given you bought a share at a given price, why should someone be willing to pay more than you did buy that particular share? And that is why a number of investors are confused. Maybe I bought a share at 30 shillings. By the time I'll be selling, will it plummet to 30 or even below 30 shillings? Or will I be able to make money? There are key factors which determine if someone is willing to pay more for the share which you bought at a less price. Among the factors are company's growth, okay? Investment horizon, okay? And all this really impact how a person is willing to purchase your share. And another interesting thing also, which is solely anchored on investors' behavior and sentiments, is also their financial goals. Maybe that particular investment or that particular share which you are holding, other person sees to be extremely valuable. Remember, I told you there's only a fixed number of shares out there. And I can give you an example. Maybe you are holding shares of a mature company where people rarely sell. Based on another person's financial goal, they might deem that share to be extremely valuable to them. They'll be willing to purchase at a higher price compared to the price you bought it at or even the market current price. That is scenarios where people are willing to pay more, okay, than you did for the shares because time has lapsed. So the business positive performances have reflected in the share, or even just the financial goals vary and they are willing to put down more money for that particular share. And so based on that, you as an investor, as I mentioned, there's two ways to make money. The first way is through share price appreciation, which I've been alluding to a lot in this video. Basically, you did buy low, you're going to sell high. The difference is going to be your share price appreciation. And then the second way is through dividends. Out here, companies, most of those mature companies, once they have done their business, right, they have gained or made profit in the market. Revenues look good, profits look good. At the discretion of the management and the board, they might decide to share part of their profits with their shareholders, right? That they end up paying you dividend, interim dividend or final dividend. And that dividend is going to add to the value of your investment. It won't really hit your share price directly, but that dividend is going to be part of what you get, and you decide whether to plow back or cash out your dividend. Those are the two ways which investors make money through investing in the stock market, right? And you as an investor, you need to be savvy to think about how you can capitalize on those two ways to be able to become rich. And I'm saying so because a good number of people out there don't become rich for a few reasons. Most get into investing with no clear goal. Someone buys, for example, shares today, they want to sell next week. Second reason, investors acting based on emotions. Guys, the stock market is brutal. The prices of whatever investment you bought is going to be going up and down, up and down. If you are monitoring every reaction from an investor, if you are monitoring any fear being spread to the market, any news hitting the market, unfortunately, you might end up panicking and selling your investment. And yet, the true value of you building wealth or even becoming rich is in having a long-term horizon, assuming the stock of that company is going to perform very well and the company is strong. That is why the majority of people out there who have built wealth in the stock market have done that in a long-time horizon. Basically, the time horizon works for them. It reaches a point to let compounding work for you. Case in point, if companies like, for example, BAT last year, they did pay dividend at 14-15% dividend yield. Standard the same. EABL, Safaricom, and the likes were somewhere between 6% to 8%. In case you're applying back this dividend to your investment, think about in 20 years, where are you going to be? Your investment is going to have really increased exponentially. And that is the way which rich people out there are making money in the stock market. Stock market does reward patience. Patient people do realize the benefit of investing and making money. Yet, most of the people out there are noise traders, right? They are waking up excited. People are buying stocks I need to buy. But then again, as soon as they are buying, they are selling. So, they're not the ones becoming rich. The ones who are becoming rich are doing their studies very well, understanding what they're getting into it, having discipline of when to review their investment, and continue to plow back their benefits. Dividends, they plow back. What not, they plow back. At the end, they see their investment grow exponentially and they become rich. I hope you've gotten a thing or two from this video. You, as either a budding investor or even already an existing investor, utilize these techniques and hopefully they can help you to also grow wealth in the stock market.